Hello, I'm Paul Single, Managing Director here at City National Rockdale, and welcome to Economic Perspectives. Economists face an interesting conundrum. There's a large gap between how the economy has been performing and how Americans feel about the economy. In a recent Wall Street Journal survey, by a 2-to-1 ratio, respondents say that the economy has gotten worse rather than gotten better over the past 2 years. Yet in reality, the opposite is true. For that period, the unemployment rate has been below 4%, a level that is considered full employment and something that we have not seen since the 1960s. The amount of job openings compared to the amount of people looking for a job is very strong. There's 1.4 jobs available for every person looking for a job. And household net worth is at an all-time high, reflecting the strength of financial assets and the value of their homes. And finally, GDP growth. Over the past year, it's been up 3%, well above the trend rate of 2%. Yet consumer sentiment is at low levels. What gives? It might be partly due to the attitude shift since the pandemic. We've seen this before. Parents of baby boomers, those that lived through the Great Depression or World War II, became very austere. They saved a lot and were frugal in their spending. They knew that one could lose their wealth or livelihood very, very quickly. Well, the opposite seems to be true this time around in the post-pandemic period. People have realized that someone close to you could quickly lose their life. So the best thing to do is spend time and money with family and friends. So there's been high spending levels and very low savings rate. The acronym YOLO is often used. You only live once. There isn't much tolerance for not getting what you want is also something that we're seeing. And of course, weighing on people's attitude is the looming geopolitical risks, with 2 wars that have the risk of expanding and a dysfunctional Congress that has passed very little legislation. So let's turn to some of the charts. This first chart shows consumer sentiment. The data has been around since the late 1970s, and there's a couple of noticeable issues. It is currently below the long-term average, and it's also below the pre-pandemic level. But what's interesting is the point that the all-time low was in June of 2022. What was going on then? What was so bad? Well, the Fed had begun raising the federal funds rate just a few months earlier, and they were making plans to increase the interest rate moves that they made for the future. The stock market had traded off 25%, but food prices were moving up quickly, more than 13% year over year. That's something that we have not seen since the 1970s. Gasoline prices hit a high of around $5 a gallon. Was that worse than the pandemic before the vaccine? Or the global financial crisis, when almost 9 million people lost their job, the stock market fell by about 50%, and home values fell by about 1/3. Clearly, 2022 was not as severe as then, but that's where it stands. So let's go look at the data in greater detail. This chart shows sentiment among the 3 major income groups. The sentiment remains below the pre-pandemic level. This chart shows sentiment among 3 different levels of education. Again, the sentiment remains below the pre-pandemic level. This final chart shows sentiment among different age groups. And again, the sentiment remains below the pre-pandemic level. So the lower the sentiment levels are generally broadly based, no matter how you slice or dice the data. However, there is one group of cohorts with a separation of views, and it will not surprise you. It's among primary political party affiliations. This data only goes back to 2008 for a full year of data. The green columns are when elections occurred. The gray is, of course, recessionary periods. The dark blue line that you see here is the attitude of Democrats, while the bright blue line is that of Republicans. The blue-gray shaded area, of course, is the difference between the two. It is evident in this chart that when a Democrat is in the White House, Democrats have a more favorable outlook. When a Republican is in the White House, Republicans have a more favorable outlook. Since 2008, the gap between the two has widened as the population has become more polarized with their political views. It is interesting to note that the gap between the two and the current and past administrations is about the same. It was 34.1 when Donald Trump was president, and it stands at 33.8 with Joe Biden as the president. Now let's take a look at what's going on with the economy. This chart shows the growth in household assets and liabilities as a percent of GDP. Asset growth has been growing faster than the economy for the past decade or so. At the same time, liabilities have remained relatively stable. The balance sheet of households has been an improving story. This chart here is an excellent report from the Federal Reserve Bank of San Francisco. This is high-frequency data. It is released daily. It measures the economic sentiment based on the linguistic analysis of economic-related news. It's volatile, so the dark blue line is the 6-month rolling average. Generally speaking, in expansionary periods, it is positive and turns negative in recessions and the period following the recession. This focuses on recent news. It's been on an upward trend since last June, about the same time that it was becoming clear that the well-publicized expectations of a recession were showing that a recession probably would not be happening. For many households, income is important. The blue-gray shaded area that you see here is the change in household income. The 3 spikes on the left side are when stimulus checks were sent out. The 2 blue lines that you see here show the change in inflation. The bright blue is CPI, the navy blue is core PCE price index. No matter what your favorite inflation measurement is, income has outpaced inflation. The line here shows personal spending. Households have been spending at a clip that is faster than their income. They've been able to do so thanks to refinancing of debt, like mortgages, which has provided more positive cash flow on a monthly basis. Also, they spent down some of their savings that they received from the pandemic period. So all of this is good fundamental news for the economy. But some areas of the economy annoy people. At the top of the list is food prices. This chart here shows the yearly change in food at home. You can see the spike in 2022 that I spoke about earlier. Although food prices have grown at just 1.2% in the past year, which is about 1/3 of the long-term average, the public looks at it a little differently. They are just comparing what the price that they used to pay versus what they have to pay now. Another concern is the price of housing. Although those who already own a home and may very well have a mortgage below 4% that's locked in, housing costs weigh on many Americans. Here you can see the home cost relative to the median family income. With a home price at 4.2 times the median household income, it's very expensive. Gasoline prices are another concern. Everywhere where people drive, they see them advertised. Although prices haven't changed much since Russia invaded Ukraine, they have been increasing since December, and that, of course, raises concerns for many people. This final chart is personal savings. At 4.1%, it is below the 6.2% average for the 5 years before the pandemic. And I think this is the strongest indicator of how the public really feels about the economy. This is where the rubber meets the road. It measures the differential between income and spending. And the strong economy that we have, if the public was really concerned about the future, do you think they would have a low or high savings rate? If they were concerned, they would probably be increasing their savings, not reducing it, especially on discretionary spending. Remember the first chart, the low point in sentiment index back in June of 2022? Well, at the time, the unemployment rate was at 3.6%, not much different than today's 3.8%. Since then, almost 6 million people have been added to the payroll. Wealth creation has been very, very strong, with the stock market up by about 1/3. Economists have long said that consumer sentiment is not an accurate predictor of the future, and we're seeing that play out. But inflation seems to be the source of the concern for many in America. This economy has not seen high inflation since the early 1990s. So although it's an improving story where we see the rate declining, it takes time for the public to notice it. Thank you for watching. I'm Paul Singal, and I'll see you next month.